The U.S. stock market. It's a behemoth, accounting for over 60% of the global stock market. With whispers of a looming recession and global economic uncertainty, many are questioning if this financial titan is about to stumble. We'll dive into the factors propelling the U.S. market to dizzying heights and the looming threats that could send it crashing down. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. The U.S. stock market has been on an absolute tear for the past decade. It's become synonymous with wealth creation and financial success. This meteoric rise is largely attributed to the unparalleled innovation and profitability of American companies. Think of tech titans like Apple, Microsoft, and Amazon. These giants and countless others have fueled the market's ascent. Their groundbreaking products, coupled with a business environment that rewards risk-taking and growth, have propelled stock prices to dizzying heights. Beyond tech, the U.S. has also produced industry leaders in almost every sector, from healthcare and finance to consumer goods and entertainment. This diversity of success stories has contributed to the unparalleled strength and resilience of the U.S. stock market. The U.S. has been an absolute magnet for investment. With a rock-solid financial system and a hustle culture that practically worships innovation, it's no surprise that businesses thrive there. Add to that a massive population with an insatiable appetite for spending money, and you've got a recipe for economic success. These factors combined have supercharged the U.S. stock market to unprecedented heights. The U.S. stock market has generated an impressive average return of 10.64% over the last 100 years, a track record that has made it a cornerstone of investment portfolios. More recently, these returns have accelerated, with the market surging an average of 14.6% in the last 5 years. But what if these returns don't last forever? Renowned investor Ray Dalio, in his book The Changing World Order, highlights the cyclical nature of empires throughout history. From the ancient Romans to more recent global powers, nations and economies have risen and fallen. While the Roman Empire didn't have a stock market, its trajectory offers a valuable perspective. It's a stark reminder that even the most dominant economic forces can experience shifts in fortune. So, the U.S. stock market has been on a pretty wild ride to the top. But let's talk about what could rain on this party. First up, we've got inflation. It has emerged as a significant headwind for the U.S. stock market. While a certain level of inflation is considered healthy for an economy, persistent price increases can erode purchasing power, dampen consumer spending, and increase business costs. Central banks often respond by raising interest rates to cool down the economy, which can negatively impact corporate profits and stock valuations. The recent inflationary surge, coupled with aggressive monetary tightening, has created a challenging environment for investors. While inflation rates have shown signs of moderation, the risk of further price pressures remains a concern. Next is geopolitical tensions and supply chain vulnerabilities. These pose additional risks to the U.S. stock market. Trade disputes, geopolitical conflicts, and unexpected disruptions in global supply chains can lead to market volatility and economic uncertainty. These factors can impact businesses in various ways, including increased costs, reduced revenue, and supply shortages. As a result, investors may become more cautious, leading to a decline in stock prices. Another potential headwind for the U.S. stock market is valuation. After a prolonged period of strong performance, valuations for many companies have reached elevated levels. While optimism and growth prospects can justify high valuations, there's always a risk of a market correction if these expectations are not met. For years, investors have been captivated by the U.S., often overlooking the potential of emerging economies. But this narrative is shifting. These markets are experiencing rapid economic growth, fueled by young, expanding populations. Governments are investing heavily in infrastructure and education, creating a fertile ground for businesses to flourish. While challenges remain, the potential for growth in these regions is undeniable. The age-old question for investors is, should you bet big on the US or spread your bets globally? While the US has undeniably been a powerhouse, it's crucial to remember that the world is a vast economic landscape. Diversification is key to managing risk and capturing opportunities across different regions. All world ETFs offer a convenient way to gain exposure to a broad spectrum of global markets. These funds invest in companies from developed and emerging economies, providing a diversified portfolio in a single investment. By spreading your risk across various countries and industries, you can potentially mitigate the impact of economic downturns in any specific region. However, it's essential to consider your investment horizon and risk tolerance when constructing your portfolio. For long-term investors, a global allocation can be a prudent strategy. But for those with a shorter investment time frame, a more concentrated approach might be suitable. While diversification is a prudent strategy to manage risk, there's no denying the U.S. has been a powerhouse for decades. If you believe in the long-term prospects of the American economy and its corporate giants, then a bet on the U.S. alone has its merits. However, remember that even the mightiest can stumble. Diversification remains a valuable tool to safeguard your portfolio. By spreading your bets across different countries, industries, and asset classes, you will be well equipped to weather the inevitable storms ahead.